Welcome, everyone. Today, we're looking at the current state of the Bitcoin market as we approach the middle of June 2026. If you've been tracking the charts, you've likely noticed that Bitcoin has faced a challenging environment lately, with price action trending lower and struggling to maintain the $60,000 support level. Over the past few weeks, we've seen consistent selling pressure, driven by a mix of macroeconomic uncertainty and ongoing geopolitical tensions that have left investors cautious. Even with significant institutional activity, such as the recent high-profile multi-million-dollar purchases by companies like MicroStrategy, the broader market has continued to show weakness. This highlights a critical lesson for all of us. The Bitcoin market is now far more complex and decentralized than any single player, regardless of how large their treasury might be. In this session, we will break down why this short-term weakness is persisting, how global macro factors are impacting demand, and what key technical levels we need to watch as the market looks for a new floor. Let's dive into the data.
Big news just hit the crypto markets that could change how institutional investors view digital assets. According to an official SEC order dated June 12, 2026, regulators have officially approved T. Price's new multi-asset crypto ETF. This isn't just another single asset fund. The approval allows for the listing and trading of shares under the T. Price Active Crypto ETF. What makes this significant is the scope. The fund is authorized to include a wide range of digital assets, potentially spanning up to 15 different tokens including Bitcoin, Ethereum, Solana, XRP, Dogecoin, and Shiba Inu. This move signifies a major step forward for institutional adoption. By bundling multiple assets into a single SEC-regulated financial product, T. Price is lowering the barrier for traditional investors to get broad exposure to the crypto ecosystem without needing to manage multiple individual holdings. With the SEC officially clearing this rule change, all eyes are now on how this fund will influence market liquidity. This still adding mindset, market sentiment might be shaky, but some of the biggest players in the game are staying the course. As highlighted in this video, Michael Saylor has once again confirmed his strategy with a simple three-word message, still adding dots. The strategy in numbers, if you look at the data and picture the scale of this conviction, becomes clear. We're looking at a Bitcoin reserve value of over $54 billion. With more than 845,000 BTC now under management. Despite a reported average cost basis of roughly $75,600, which puts the current position at a temporary drawdown, the strategy remains unchanged. Saylor is not just holding. He is continuing to accumulate, betting on the long-term horizon regardless of short-term price fluctuations. The big picture, this stands in stark contrast to the broader financial narrative. What you're seeing on your screen is the CoinGlass liquidation heat map for BTC/USDT. Look closely as we hover the cursor over the 48-hour chart. You can see the heat map illuminating zones of intense liquidations. As the cursor moves across different price levels, shifting between 63,000 and 64,000, the pop-up window tracks the exact liquidation leverage in millions of dollars. This is crucial for traders. Those bright, colored bands represent areas where high levels of leverage are concentrated, acting as magnets for price action as the market searches for liquidity. Macro perspective. Now let's widen our lens. By switching the time frame from 48 hours to 1 month, the narrative changes significantly. The chart now spans back to mid-May, painting a picture of a consistent downtrend. Notice how the liquidation zones, those vivid green and yellow streaks, are distributed across a much broader range. As we scan the cursor across this longer-term data, we see massive concentrations of liquidity building up at higher levels that have been left behind by the recent price slide. This visualization is essential for understanding where the trapped positions are sitting. Trading implications and conclusion. So, why does this matter? Liquidation heat maps reveal the hidden battlefield of the crypto markets. When you see these high-intensity zones on the map, you're looking at areas where traders are over-leveraged and prone to being wiped out. Market makers often push price toward these clusters to trigger those liquidations. In other news, the landscape for Bitcoin is shifting rapidly, and the institutional narrative is gaining real traction. As highlighted in picture, news broke that SpaceX now holds approximately 6% of its corporate treasury in Bitcoin. This is a major signal that big tech firms are increasingly viewing BTC not just as a speculative asset, but as a legitimate treasury holding. The contrarian view, however, it's not all one-sided. If you look at the picture, you'll see a very different perspective from industry veterans like Arthur Hayes, who recently suggested that Bitcoin could end the year below the $100,000 mark. This reminder that even the most bullish analysts have different timelines keeps the market on its toes. So where does that leave us? Between SpaceX's massive institutional adoption and cautious price predictions from figures like Hayes, the market remains in a classic state of tug-of-war. Whether you're focused on the long-term treasury play or short-term price ceilings, one thing is clear. The conversation around Bitcoin's value is more heated than ever. Today, we're peeling back the curtain on how to actually read a Bitcoin price chart. If you've ever looked at a chart and felt overwhelmed by the squiggly lines and bars, you're not alone. But today, we're going to simplify it. We're focusing on 3 pillars of technical analysis that help traders navigate the volatility of crypto: support, resistance, and the trend shift. Whether you're looking to day trade or just understand the market better, these are the fundamental tools you need to spot high-probability setups. The basics: what are support and resistance? Think of support as a floor. It's a price level where buying pressure is strong enough to stop the price from falling further. When Bitcoin drops to these levels, buyers often step in because they see value, causing the price to bounce back up. On the flip side, we have resistance, which acts like a ceiling. This is where selling pressure builds up, stopping the price from rising higher. When price hits the ceiling, it often struggles to break through, leading to a pause or reversal. Pro tip: never view these as exact lines. Experienced traders see them as zones. Think of them as areas where the market is likely to react, not just a single dollar amount. Identifying the trend shift. Now, what happens when price breaks these levels? This is where the trend shift comes in. A trend is simply the path the price is following, defined by its highs and lows. Uptrend: a series of higher highs and higher lows. Downtrend: a series of lower highs and lower lows. A trend shift occurs when a market structure changes. For example, when a downtrend breaks above a key resistance level or a previously established high. This is a signal that the sentiment is shifting from selling the rallies to buying the dips. It tells us that the dominant force in the market is changing hands from sellers to buyers, or vice versa. Liquidity and market psychology. You'll see the word liquidity marked on the chart. In crypto, support and resistance levels are essentially liquidity zones. Because so many traders use the same charts, a massive number of buy and sell orders tend to cluster at these points. Market makers know this. They often look for these areas to execute large orders. By identifying these zones, you're not just looking at lines. You're looking at where the smart money, the biggest participants in the market, are likely to be active. Putting it all together. So how do you apply this? Zoom out. Always check higher time frames, like the daily or weekly chart, to see the major zones the entire market is watching. Wait for confirmation. Don't just trade every time the price touches a line. Wait for a candle to close outside that zone, or look for a volume spike to confirm the move is real. Manage your risk. Support and resistance help you define exactly where you are wrong. If you buy at support and the price breaks below it, that's your signal to exit and protect your capital. Technical analysis isn't about predicting the future with 100% certainty. It's about managing probabilities. By mastering these zones and recognizing when a trend is shifting, you put yourself in a position to make much more informed decisions. Keep practicing, keep watching the charts, and you'll start to see these patterns appear more clearly every day. Thanks for watching. Subscribe for updates.